Good morning and welcome to this Monday, February 22nd, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it looks like a new week and a new gap down. Market's not looking very good this morning. Got on pre-market action, we got the Dow right now down 145 points, the S&P down 24.5, and the NASDAQ getting hit the hardest in pre-market, down a little more than 1%, down 154 points. So it looks like a little bit more of what we were seeing last week in terms of, early weakness. We'll see whether or not it morphs into anything that's maybe a little bit more, bearish in the near term. I'm not sure that at this point I would call what we've seen so far bearish. It's been more just, kind of consolidating off of the run we had to open up February. But we had a negative divergence that had printed over, middle part of February. And it's not unusual this time of February to see a little weakness in the market anyway. So I wouldn't be too concerned about it. I'd marked a couple of support levels. I'd be watching, somewhere around the 3860 to 3885 area. That's kind of a zone that I think will be important to keep an eye on for the S&P 500. And, I'll show you that here in just a couple of minutes, where what I'm looking at. I'm just kind of glancing at an hourly chart for that. But we're going to get into all that in just a moment. I do want to take folks over, especially if you're new, to Earnings Beats, where you can sign up for our free newsletter and join our community. It's the Earnings Beats Digest, published Mondays, Wednesdays, and Friday mornings before the market opens. Normally, the topic is, it's a brief publication. I mean, normally it's a couple paragraphs in a chart. But normally it's about an individual company that's reporting earnings, or maybe has reported earnings, or just looks interesting on the chart. A lot of times we feature relative strength, that sort of stuff. But it's very educational. I think it presents some pretty good opportunities, trading opportunities from time to time. But again, it is completely free, no credit card required. You can unsubscribe at any time. Just simply type in your name, email address, hit that subscribe button, and we'll make sure that we get the next newsletter article out to you. Also, if you'd like to join our service, got that Join Today button right there. We have a no-cost 30-day trial. So you get charged $7 up front. We refund it to you within a week or so. And then you can enjoy 30 days of our service at no cost. You can check out the performance of our portfolios. We did just have what I like to call our draft day yesterday. Just announced the 40 stocks, 10 each in each of these four portfolios. And each stock is equal weighted that goes in. So we have 10 stocks to go into each of these four different portfolios, and we'll hold them for 90 days. So February 19th is the date that we do the draft. We also do it May 19th, August 19th, and November 19th. And so we hold until May 19th. So it's really a combination of buy and hold and trading. The trading concept is that you're constantly looking every 3 months to fill out your portfolio with leading stocks and leading industry groups. So as the market begins to rotate and shift, you can take advantage of that. So that's a little bit more of a trading type of a mentality. But the buy and hold is that once you get in, at least for us, our members can do whatever they want to do with them, but we don't trade them. So no stops, no profit taking. We just hold them for 90 days. And the idea is that there will be enough leaders in that portfolio that we'll have a couple of big winners, hopefully, to carry the portfolio. The ones that do fall back, hopefully the leaders and the winners do better than the ones that don't perform well. But our track record's been pretty solid over the last couple of years, a little over 2 years on the model portfolio. You can see the inception dates here. But you can check out those returns. We have announced these portfolios in real time every quarter since we started. And I think the numbers speak for themselves as far as following leaders, leading stocks and leading industry groups. Anyhow, we'd love to have you check us out. So either the free newsletter, or if you want to join our paid service, we'd love to have you. And let us know what you think of our service. If you have any questions, you can always email us at support@earningsbeats.com. All right, what happened on Friday? Well, you can see the Dow Jones, 0.00%. That's a pretty flat day. We were up, we pulled back, we finished up less than 1 point on the Dow. S&P was down 7, so a little bit of underperformance there versus the Dow. And the NASDAQ was up 9, so essentially flat as well. Really not a whole lot by the end of the day, more just sideways consolidation. And kind of interesting that there wasn't more volatility on Friday, given the fact that it was option expiration day. But we had some volatility throughout the week, and I guess maybe everyone was exhausted by Friday and just wanted to be done and enjoy the weekend. Anyhow, mid caps up 1.5%, small caps 1.7%. So there was definitely a little bit more excitement there. I think some of what was going on is, we'd been in an uptrend, and as you look at the NASDAQ and the S&P and the Dow, especially the NASDAQ, you've got a lot of companies on the NASDAQ that are optionable. And so you're going into options expiration. We'd had a big run. I think it behooved market makers to bring prices down a little, or certainly not let them continue rising. And so I think that played a role a little bit in what we saw in the market last week. But mid caps and small caps don't tend to have as many companies that are optionable. And the ones that are many times don't have the volume that some of the NASDAQ stocks do in the options world. So I think, you get a little bit more, there's not as much need for manipulation around option expiration day, is the way I would put it. So anyhow, those two indices outperformed on Friday. Materials, energy, financials, and financials. I got financials in here twice. I'm trying to think who the fourth one was supposed to be. Anyway, those three at the top, you can see, had solid days, up more than 1% each. So that was really good. And then utilities was at the other end of the spectrum, down about 1.5%. But that's really what we've been seeing. One thing I will say, if you look at the accumulation distribution line on all of the indices up top, and you can see these three sectors here, all of them are printing new highs, all of them. So 8 for 8. And then utilities, the one area where we've been much weaker, you can see there's more distribution, folks getting out of utilities. Still with, you would think, well, they pay pretty good dividends with the yield down, but with the yield rising, it's starting to make those dividends not quite as attractive. And then, we're in a market where I think more and more folks are looking at capital appreciation because the yields aren't what they've been in the past. So as a result, I think there's just money been flowing out of some of the defensive areas, especially utilities. All right, 10-year Treasury yield. Well, as far as economic reports go, later this morning, we will be getting the January leading indicators out. The expectation is for a rise of 0.3%. As far as December goes, it also rose 0.3%. So for January, we're not really expecting anything much different, just looking for that rise of 0.3% to match December's. The 10-year Treasury yield, though, has been on a tear to the upside. It has taken out that reaction high back in March. I think we need to probably step this back to maybe a longer-term weekly chart. And I'll show you where I think we're probably heading. And I'll annotate this. I think there's a couple levels to watch. The first one would be this low way back here, and we're there now, about 135. And then the other would be the low that we saw in September 2019, right about close to 150, 1.50. So I believe we'll probably find a short-term top in this area. But you can see, the momentum to the upside is very strong right now. I don't know that we stop there. The next level, if we do get through, we could make a push toward 2%. And if we do, I can promise you there is going to be a lot of negativity in the media about interest rates rising and how that's going to impact the stock market. Let me just tell you something. If we get GDP, the only reason it would go up to 2%, by the way, is if the bond market really believes that the growth is going to be very significant going forward. Now, if the growth, which is already anticipated to be maybe as high as 5% GDP, if you get 5 or 6% GDP, because I think it could be 6, I think it could be higher than 6. I think there's a lot of pent-up demand. We'll see how things evolve here in 2021. But I believe the economy globally is going to be incredibly strong this year with tremendous pent-up demand. Everybody's been cooped up, for the last year. And I think that folks want to spend money. I mean, we've seen it online. I think you're going to see it offline as well as you get into, and throughout 2021. But if the interest rates continue to move up and money pours out of the defensive treasuries, which is what I would be doing if I held treasuries and the stock market keeps going up and earnings are crazy right now. I'm not even going to get into that, but they've been blowing away estimates on average. So if I've got a choice, I want to get out of treasuries. Well, when you sell your treasuries, yield goes up. That's automatic. It's an inverse, 100% inverse relationship all the time. And so you need to understand that relationship. When you see the yields going up like this, it means money is rotating out of treasuries. And we haven't seen this kind of a push to the upside in a long time. That money tends to find its way into the stock market, which is why the stock market has been going up throughout the past year, because money's rotating out of the treasury market, moving into equities. But I think we're going to get up into this one, we're at 135, so we're already to the first level. I think we could get up to 150, and there I would expect to be some consolidation. I don't know that we're going to go, I certainly don't expect we're going back down to 0.5%. That would be shocking to me. I think that was the bottom. I think we're not going to see that again probably for another generation or two. I just would be shocked to see yields go back down to where we were. I think we had a bubble in the treasury market and bond markets globally. So I think money's going to continue to pour out and move into the stock market. But I wouldn't be surprised to see some consolidation. I mean, just to move up unabated without any kind of pullback would be, not that it can't happen, could, but I just think that at some point we'll probably pause and consolidate for a while. And so I think this area right in here is an area where we could do that. Now, if we don't and we get through 150, I think we really could be heading for 2% or 195, something like that. And this move to the upside, that's a lot of money coming out of the bond market and a lot of money potentially to go into the stock market. And everyone gets really spooked when interest rates start rising. Everybody thinks, oh my gosh, interest rates are going up. That means everything's going to slow down. Well, if growth is 5 or 6%, and you've still got yields of 2%, think back 10 or 20 years ago. Can you imagine what we would have been thinking if we knew that the 10-year treasury yield would be as low as 2%? I mean, we went down to almost zero, but 2% is ridiculously low. I wouldn't worry about interest rates unless the 10-year treasury yield started moving toward at least 4 or 5%. If we have strong growth, we can handle 2%. We can handle 3%. We can handle 4% if the growth is there. Now, if the growth's not there and yields are rising simply because of something like inflation, okay, then we got a little different problem. But I think it's going to be the growth. I think growth is going to be a big driver in 2021 and into 2022. I think this decade is going to be very strong. Again, just my opinion, but based on what I'm seeing on the long-term charts, based on all the signals I'm seeing in intermarket relationships, this isn't just, Tom hoping that the market goes up. All the signs that I look at tell me we're going higher. The pace at which we go higher and when we get our pullbacks, that's up in the air as far as, it's hard to say exactly when you're going to get a pullback, when you're going to consolidate, unless you start to see some short-term signals. But in the meantime, I would be looking for slightly higher treasury yields. I wouldn't be surprised if we go a little higher. I think we should consolidate that move up for a little period of time. And then I think we probably will continue to move higher over time. All right. So anyway, that's kind of an expanded look at the 10-year treasury yield. But I think it's important because a few months ago, when I was very, very bullish, and we had already come up off the bottom quite a bit, and I was getting lots of questions. What's the catalyst going to be? How can you say the market's going to go higher? What could possibly drive the market higher? Well, we're seeing earnings absolutely crush estimates. That's one major driver. And number two, I believe the money's going to rotate out of the bond market. I think we had a bubble. I mean, money rotates from various asset classes. That goes on all the time. But big picture, we have seen so much money go into the bond market over the last 40 years, but especially over the last several. That's the money that's going to come back out and is going to chase these earnings to the upside. Again, in my view. Now, at some point down the road, I don't know when that's going to be, probably still years away, but at some point, the treasury yields will move up to a level where, portfolio managers are going to sit back and say, wow, okay, earnings growth is slowing down a little bit. Now I can get 4% on a 10-year treasury yield. Maybe I want to take a little money off the table and start, getting a little bit more defensive over here, be a little cautious, take some of my profits. That'll happen at some point down the road, and that'll spook the equity markets. And that's when we'll probably get a 20% correction, a cyclical bear market. But I think it's still all going to be within the context of a much bigger uptrend in the stock market. And here is your catalyst: money rotating. It's going to be new money coming in, but money rotating and then earnings growth. Continue to watch the companies that can produce earnings that beat estimates. I think that's going to be the combination, the two drivers that take the market higher. All right, let's take a look at the S&P 500. I mentioned the S&P, and I mentioned the 3860 to 3885 area. So let me show you what I'm looking at here. So right back in here, you had these tops. You can see the hesitation to sell off at the end of January. And then we came roaring back and we went through 3860. That was those were the prior tops. So on the way back down, 3860 kind of seems like a natural gravitational level during any selling. Also, the 3885 that I mentioned, these are the two lows right here. So if we, let's just come back out of this. And so if you inspect and you look here, this low was 3884.94. So basically 3885. This low was 3885.03. So we got two lows over the last couple of weeks. Now, if we lose this level, does that mean, the bull market's over? Of course not. These are short-term levels. I mean, we could easily go into some sort of a short-term funk. I don't know, the market comes up, with lots of different things. I mean, just less than a month ago, even just 3 weeks ago, we were down 3,700. There's nothing to say we couldn't possibly go down there. I mean, I'm not seeing anything at this point that suggests that, but big picture is different than short term. Short term, I'm watching these couple levels. Big picture, you get off of this chart, you go out to say a 15-year monthly chart. Looking at this monthly chart, do you think 3885 means anything? 3860? I mean, the rising 20-month EMA is 3,200. We do occasionally get tests of that. Now, I'm not expecting that anytime soon. I believe we're going to continue going up. At some point down the road, we'll have that 20% pullback that I'm talking about. It'll be a cyclical bear market. Maybe it's in a year, maybe it's in 4 years. I don't know when it's going to be. At some point, we'll have that 20% or more sell-off during this secular bull market. And we'll test that rising 20-week EMA, maybe even pierce it a little bit like we saw during the trade war there or the pandemic. But when you look at the monthly chart, it doesn't look nearly as bad as the week or the daily chart where, obviously we had the huge hit back in March. The fourth quarter 2018 was brutal on a daily chart. On a monthly chart, it just kind of smooths out all that noise. And I think it's pretty clear we're in an uptrend here. Monthly PPO is on the rise too. And when you see the monthly PPO on the rise, generally speaking, I mean, look at what happened 2013, 2014 when we were rising. This whole period, we just kept moving up. Market was very boring. And I love a boring market. I love a market that, volatility gets squeezed out of it. And the days, we don't have any massive moves to the upside, but we get rid of all these spikes and fear to the downside. And it's just this slow, steady move to the upside that is like a slow death for anybody shorting. And for me, as a short-term trader, it's just nirvana because you're just constantly seeing money rotate. If money comes out of one area, it goes into another area. The market doesn't take a hit. And so anyway, that's kind of my favorite market. I like a boring market. Let's take a look at some of these sectors. So this is a 10-year chart of technology. And you can see the move up. This is just the absolute chart. So this is just the price of the XLK on a weekly basis for the last 10 years. And then you look at the relative strength of technology versus the S&P 500. And you can see that throughout, everyone wants to always bail on technology. Stocks have gone up too much. They just, it can't go any higher. And yet for the last 10 years, really, with maybe this 1 9-month exception here, and maybe this 3-month exception here, we've been going higher pretty much 10 years on a relative basis, which means as the S&P's been going up, technology's been going up even faster. And I'm going to go in and show you, if you didn't see this article, you should go pull it up and read it. But in my Trading Places blog, and I mentioned this last night when I was doing the draft, one of the, when we pick our stocks for our portfolios, we're doing our homework before we just start picking stocks. And this was a spreadsheet that I had done calculations on the XLK, well, all of the sectors, and how they've performed since April 10th, 2013. And I'll explain that date in just a minute. But here you can see the prices at that time, the prices as of about a week ago, and there's your gain loss, and here's your percentage. So throughout this bull market, secular bull market, the XLK is up 413%. XLC, communication services, 274%. XLY, consumer discretionary, 253%. And the S&P 500, 148%. So if you're looking to beat the S&P 500 in a secular bull market, you want to concentrate on those three areas because that's where the money rotates to, but especially technology. I mean, I know a lot of folks just want to diversify and want to, let me put my little money in my technology basket, and here's money in my energy basket, and here's my real estate basket. Well, look at the energy basket and the real estate basket versus the technology basket. I mean, I understand the basic concept of diversification. If you don't understand or you don't think where you have no opinion about what's going to happen in the stock market, you just want to be invested and you don't have a clue what could possibly lead, then getting in and just diversifying makes complete sense. But if you study the market and you follow the periods and the cycles that we go through, look at these numbers. In this bull market, I just feel like every dollar I put into any of these groups toward the bottom, which are mostly your defensive groups, any dollar that I put in there, I'm costing myself money. That's the way I look at it. Now, maybe, you might say, well, you're too aggressive. Well, if that's the way you look at it, I kind of feel like my risk is not being in these stocks that are leading during a bull market. Could I be wrong? Could we go into a bear market? Of course, anything can happen. I don't have a crystal ball, but after studying the market and looking to see what Wall Street's doing and where they're putting their money, this is not setting up to be a bear market ahead. This is setting up for a continuation of the secular bull market that we're in. And looking at these numbers, where do you want to be? I can tell you, we just did the draft last night. You're not going to see too many stocks in these areas down here. You're going to see almost all of our stocks in these areas up here and leading stocks within these areas. Not just any old technology stock. We want to know where Wall Street's going with their money. And so I think this is a really important part of, following the stock market. Now, I didn't have the chart in there. Let me show you. Look at this chart. So this is the, my 100-year big picture chart that I always look at. Here, this was a secular bear market for 13 years. We went nowhere. We're in a secular bull market right now. I don't even know how you can argue after going through the trade war, after going through a 100-year pandemic. Here we are sitting at all-time high. Just about everyone is like, I don't understand how this is happening. It can't be right. I've got friends that I sit down and talk, about the market sometimes, and they don't follow it the way I follow it. And they're like, the pile of debt is too high. Inflation's going to be horrible going forward. This, that, and the other. I mean, when that's what you're being fed every day by the media, that's going to be your bias. And I think all of us, I think humans by nature just tend to be a little pessimistic, always, focusing on the negative and not really caring about the positive. And so it is a psychological game in the stock market because every time we pull back, there's a reason why this is the start of Armageddon. And so you get that ingrained. It's like, oh my gosh, I don't want to buy. Market's pulling back. When it's going up, you think if it just pulls back a little bit, I'll get in. And then it starts to pull back and you start seeing news stories and you're like, oh, it's going down further. And then next thing you know, we're back at an all-time high and you're saying that, well, it shouldn't be there. So I'm going to wait. Well, I mean, look at the secular bull market from the 1980s to the 1990s. Look at the 1987 crash, very scary at the time. Market just yawned and continued moving higher. I believe that's what we're going to see here with the S&P 500. I think we're going to continue seeing it move higher, obviously with pullbacks along the way. But that date that I showed you in this article right here, April 10th, 2013, that's the date when we broke out above this double top right here. That was April 10th, 2013. That to me is the start of a secular bull market. Now, if I went back and I did this same exercise from 2000 to 2013, I can promise you the makeup of these percentages was completely different. Because a secular bear market, we don't look for aggressive areas of the market. Wall Street bails on growth and aggressiveness and concentrates more on defensive areas. And so anyway, that was a long talk about it, but I like to get into that because it really sets the groundwork for why I'm bullish. You know, I don't want to just sound like I'm always bullish. I mean, I wrote an article back in September when we topped that there were short-term signals suggesting that we were going to top. I don't always write bullish, but my big picture is bullish. Even when I was short-term bearish in September, I was still long-term bullish. But as a short-term trader, you don't want to get caught up in that big picture because you're looking to make money in the short term. And if the market goes against you and you're long and the market goes down for a couple of months, that can be painful. So it's, you know, kind of walking a tightrope a little bit. All right, let's keep moving on here. Going to get into some earnings. So the first company that I saw a report this morning was Discovery, DISCA. It's been on a huge run. You can see AD line looks good. All the relative strength lines look good, including broadcasting and entertainment relative to the S&P 500. So it's in a good group, and it's been a great stock. Well, you shouldn't be too surprised. They beat 76 cents versus 73 cents. That's why we've been seeing all this money rotate into it. This is what Wall Street does. They go out, they meet with management, they find out what's going on in the company, and then they either buy or sell. And when you see relative strength, you can assume that Wall Street likes what it's seeing and hearing from management. Well, now we find out. DISCA, 76 cents versus 73 cents. Stock's up a little more than 4% pre-market. Now, the reaction to earnings is not always, you know, the greatest. And I'll show you a couple examples here in a minute. But another company that reported is Dish Network. AD line here, not quite as good. Look at the highs we saw all the way back over here. Double top at $38 back in June. And here we are sitting at 33 and change. Clearly not one of the best stocks out there. Dish relative, and this is also in the broadcasting area. So you see the difference? Look at the selling, the big volume selling here. And then you go back to Discovery and look at the big volume buying. That's Wall Street. I mean, if you just, you know, think about what these charts are telling you. They tell a story. And so I look at a stock like Discovery and I'm like, Wall Street's buying. They like what the company is saying. And then you go to a stock like Dish and Wall Street's not impressed. And we've got tactical hurdles to cover. We got, you know, volume on downside. That tells me distribution. The AD line recently near 52-week low. All of these things combined tell me, you know, and this is in a group that's been doing well. But look at Dish on a relative basis. Now, they came out with great numbers, much better than Discovery in terms of relative to their estimate. Dish, $1.24 versus 75 cents. And this is where a lot of folks just can't quite get their head around why the market is the way it is. Discovery went up 4% with a slight beat on earnings. Dish looks like it blew it out of the water, and Dish is up 0.5%. It's for whatever reason. And again, I don't try. One of the things I learned a long time ago about the stock market is stop asking why questions. You can ask a lot of what questions, how questions. Stop asking the why questions. You know, why is the market going higher? It just is. And you can accept it and follow it, or you can try to, you know, be that person that stands in front of a freight train and tries to, you know, argue against the market. The market has a will of its own, and good luck trying to convince the market of your views. Same kind of principle with the, looking at these individual stocks. For whatever reason, you can say, why is Dish not getting a good reaction? Discovery did. Again, ask those why questions if you want. I'm just looking at the charts. This is a stock that's out of favor. Distribution is what it is. I don't care what the earnings are right now because relative strength is so poor. Now, when relative strength starts to gain steam and this stock starts to outperform its peers and its peers are strong, then we got a different story. Then I'll be singing the praises of Dish. So part of the deal is earnings, but part of it is also looking at the charts, technically what's going on. I mean, if Dish continues to produce those kinds of earnings going forward, then yeah, eventually it's going to be rewarded. But for some reason, it's not right now. Here's one. Market just opened here. Royal Caribbean Cruise Lines. Now, they were expecting a loss of $5.04. That's a lot of money that they lost or that they were expected to lose. The good news is they beat those estimates. They only lost $5.02. So, and it's getting a nice gap up. This is not trading right now based on its fundamentals. Obviously, if a company's losing that kind of money, it's going to, be out of business after a while. What the market does, though, is it looks ahead. So what it's seeing is things improving for the cruise lines. And that's why we're seeing this move to the upside. That's why, we're above the June high and we're way off that March low. This was the forecast. This was the market's forecast of what was going to happen to the cruise lines. And it did. These stocks, I guess maybe a little pun, but they were sunk for a few months. Now they've tried to battle back and they're doing better, but you can see relative to recreational services, Royal Caribbean's been downtrending. Relative to the S&P, it's been going sideways for months, but that was after a huge decline in relative strength. So it's kind of like a dead cat relative bounce that we saw through June. And since then, this has not been a stock to outperform the S&P. This is not a stock you want to own to outperform the S&P. Now, if it starts to break out above these other relative highs, then yes, maybe so. But for now, I'd be a little careful with Royal Caribbean. All right, we're going to wrap up with the three you must see. And these three are all going to be earnings-related stocks. They're all big movers after earnings. And I just want to kind of highlight how crazy earnings can be and the reaction to earnings. I'm going to start off with, and I didn't look at guidance or anything like that, so I don't know what they forecast. All I know is bottom line, what they reported versus what was estimated according to Zacks. So first one I want to show you is Cooper Tire and Rubber. Look at that huge gap up. I mean, this stock is up 20% today. And if you just looked at the chart and somebody said, well, it was earnings, what would your first thought be? Wow, they must have blown out earnings. They must have blown it right out of the water. They were expected to earn 92 cents. They earned 75. They missed earnings by 17 cents, according to Zacks. Now, maybe there's some other services out there that show it as a beat. But according to Zacks, they missed by 17 cents. So obviously, they must have come out with some other news. Buyback, maybe somebody's bought them. I don't know. But going up 20% is crazy based on missing your earnings estimate by so much. Now let's flip to the other side. So now let's say you're in MGI and going into earnings, you're like, I'm going to take a chance. Stock's been, performing really well. It's down 24% today. You want to know what the earnings were? 12 cents. Market was expecting 8 cents. So they beat by 50% on their earnings and the stock's down 24%. If you want to understand why people don't get the stock market, those two right there, that's your poster child of, these two stocks. One misses by a mile, goes up 20%. The other one beats by a mile and goes down 24%. The other one I wanted to mention is a smaller company as well, just like MGI, but this is GLOG, G-L-O-G, GasLog. They actually beat 24 cents versus 22 cents, and you can see up 17%. So another big mover with earnings. Got some overhead resistance there, a little above 6, but we'll see what happens after the gap up, whether or not we can make that breakout. My guess is with that kind of a break to the upside without making the breakout on the open, I think we could run up to 6 or a little over 6, but I suspect by the end of the day, we'll probably pull back on this one. That would be my guess. We'll see whether or not I'm a soothsayer later today. All right, that's essentially what I had for today. Let's go over, see what the market is doing. Yeah, down just like it was in pre-market. Dow 196 points, S&P down 30, 38.76. So we're in that 38.60 to 38.85 area. We lost 38.85. So short term, that first level I showed you is gone. Probably going to work our way down to 38.60, I would imagine. And then NASDAQ down 195 points. One last thing I'll mention this. And I think I talked about this in our Max Payne webinar last week with our members. I know I mentioned it, but between the shows, the blogs, the various webinars and so forth, the daily market report, I can't remember sometimes where I post something, but one interesting fact about the stock market, the Mondays after options expire, that is essentially the worst day of the market. And today is that Monday after options expire. Options just expired on Friday. So don't be shocked on the Monday after options expiration when we're down. I believe I had done a study at one point. And if you look at the days of the week and how often they go up, I think it was Wednesday, Thursday, Friday go up about 60% of the time since 1950. Wednesdays, Thursdays, and Fridays. As you get to hump day and you get to the end of the week, people are in a better mood. You know, not too many people talk about the Friday blues. They always talk about the Monday blues. By Friday, you're excited. The weekend's coming. So I think psychology plays a role in the stock market. So Wednesday, Thursday, Friday tend to be very good. Mondays and Tuesdays. Tuesdays, I think the percentage of up days is like 52% versus 60% on Wednesdays, Thursdays, and Fridays on average. And then Mondays are 47%. That's, I think, statistically relevant when you go back 70 years. I mean, you think on the one hand, well, it's just one day of the week, but it's one day of the week of every year for 70 years. That's a lot of days to have that kind of difference between Monday and Tuesday versus Wednesday, Thursday, Friday. But anyway, Mondays, 47%. But I went back and looked at the Mondays, that just the Mondays. Actually, I think what I did is I took the Mondays from the 19th to the 25th, because we know that's the bearish time of the calendar month. So I think I looked at all Mondays that fell during the 19th to the 25th. And those Mondays went up only like 37% of the time. So in other words, 2 out of every 3 Mondays that fall during the 19th to the 25th of the month, almost 2 out of 3 go lower. So, you know, as a trader, I'm always looking for any advantage I can get. And that's an advantage that's worth knowing, that Mondays that fall this time of the calendar month, don't expect, you know, don't be shocked when you wake up and you see futures like this. Now, the other side, and I see, you know, we're trying to erase some of the losses right now, S&P back to 38.85. The other side is all the accumulation that we've been seeing in the market after the opening bell. This goes back to the whole pandemic. You know, the AD line's been really important to us. So when we do see selling a lot of times at the open, we see the market recover. So that would be the other thing to watch today. Can we recover some of these losses? If we do, then the AD line will probably go up, even though the price goes down in the market. Something to think about. Anyway, that's it for today. Appreciate everybody stopping by. Again, go over to Earnings Beats and check us out. If you're not already an Earnings Beats Digest member, you can sign up there. Hit the Join Today button. You get a 30-day no-cost trial. Come in, check out our portfolios and all the amazing research that we have at Earnings Beats. Love to share it with you. Everybody have a great day. Be back tomorrow over at Stock Charts TV for a recorded version of Trading Places Live that'll air at 9 a.m. Eastern at Stock Charts. Everybody have a great day. Happy trading.